With the market experiencing continuous high volatility and radical moves almost every day for more than 3 months at this point, it can be nerve-wracking and dangerous for a trader to make a decision between going long or short on a trade, especially a trade that you're holding overnight. You never know which headline will come out overnight that will destabilize the market and wreck your trade. I'm the head trader of S&B Capital's options trading desk here in Manhattan, and the traders on our desk have learned and developed techniques for overcoming this problem and actually turning that problem into an incredible trading opportunity without having to pick a direction, long or short, on a particular stock or index. In this video, we're going to be going over an easy to understand and vivid example of how options traders take advantage of these kinds of circumstances without having to pick a market direction. So stick around because I think you're going to find this intriguing. Hi, I'm Seth Freuberg, and I'm the head trader of S&B Capital's option trading desk. S&B Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. So as the financial markets continue to gyrate wildly as a result of the economic impact of the COVID-19 pandemic, the top day traders in our firm are having incredible success making often in 1 month what it would take them to make in a full year in any other kind of market. But what many options traders don't realize is that similar incredible opportunities exist for options income traders, because in this environment, the options market, which is really a derivative of the stock market, is responding by creating similar historic opportunities that smart traders understand how to take advantage of. So for example, let's take a look at the NDX index, the NASDAQ 100 index, which tracks the price movements of the major tech companies such as Microsoft, Apple, Netflix, Alphabet, and many others. And as you can see, the index has moved wildly over the last 3 months, first selling off 31% and then roaring back with a nearly 50% rally, blowing through all-time highs in the process. But what most traders don't realize is that while such movement is taking place, there's a dramatic effect on options pricing taking place at the same time. And that dramatic change in pricing gives rise to great trading opportunities, particularly if you're trading index options. Now, before we jump into that, though, we've got to make sure that everyone understands the basics of index options. So for those of you who already understand index options, hang in there. This is going to be very quick, and then we'll jump into the key principles of this lesson, which will be worth your wait. Okay, so now almost all of you are familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option that entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also something called index options, which work similarly to equity options, except there's no such thing as 100 shares of an index like the NASDAQ 100, known as the NDX. You can't really buy or sell 100 shares of an index, but what you can do is to get paid in cash, $100 per point, if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point in the index that drops below the strike price of your index put. So for example, if the index is trading, let's say NDX index is trading at 9,500 and you buy the 95.10 call, if the index goes to 95.15, you'd receive $500 in your account. If the index closes at 95.10 or lower, your call expires worthless. On the other side of the ledger, if you buy a 94.85 put and the index sells off to say 94.75, you'd make $1,000. But if the index just sold off to 94.85 or higher, the put would expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will allow you to sell options as well. And your broker will allow you to put together combinations of options. In other words, option strategies that involve both short and long options purchased in a way that is advantageous to you as a trader. Okay, so now that we're clear on how index options work, we can focus on how options traders can apply them to take advantage of these current market conditions. Now, it's important to understand that most options income traders, like the traders on our desk, are involved in trades that have a duration of anywhere from 30 to 90 days long. But in circumstances like today's volatile market, we can basically be in and out of our trades in 4 or 5 days, scoring the kinds of returns that you'd expect in a trade that you're in for a month or two. So let's take a look at a recent example. So Let's take a look at a very common option strategy known as the Iron Condor that you could have implemented on the trade that would last just 4 days in late April when the NDX index was trading around 88.50. So to put this particular Iron Condor together, we'd start by buying the 9130 NDX index call for $30.05, expiring in 4 days, which is May 1st, which is way above where the index is trading. And then we'd move down 20 points closer to the index price and sell a 9110 call for $34.90, which is more than we paid for the 9130 call that we bought, which makes sense because it's closer to the index price. But still, even then, it's 250 points higher than where the index was trading that day. Incidentally, selling a call closer to the money and buying a call farther away from the money, that combination is called a call credit spread. And we've discussed that before. Now, at the very same time, we'll move down 300 points below the market. And as you can see, we're selling the 85.50 put for exactly $47. And for protection below that, we'll buy the 85.30 put and we'll pay $43.70 for that one. And that combination is called a put credit spread. So in other words, an Iron Condor is a combination of a call credit spread and a put credit spread. And so now at this point, we've created a full Iron Condor. So now let's take a look at what's happened exactly cash flow wise on this Iron Condor. You see, we paid $30.05 for the 9130 call, but remember, each call represents $100 per point. And so that is multiplied by $100 for a total cost of $3,005. But we also sold the 9110 call for $34.90, which brings in $3,490 in cash, as you can see from the calculation. And so you can see we also received $4,700 for the 85.50 put, but we sold below the market and paid $43.70 for the put we bought below that. And when you net it all out, we actually received $815 in our account at the outset of the trade, which again will expire in only 4 days. Also keep in mind that for reasons we can cover another time, the worst that you can lose in the trade is $1,185. So that is really the capital that you've dedicated to this trade if you think about it. The worst case scenario, $1,185. Now, here's what's interesting. If you were to go back to January 6th and enter into the identical Iron Condor, 4 days from expiration, 555 points between the short call and the short put, you'd only receive a credit of $206, and your risk would skyrocket to almost $1,800. And that's logical if you think about it, because in less volatile times, the chances of your having to pay the buyer of the call you sold or the buyer of the put you sold any money, which only happens when the market gets past the strike price of that option. Well, when the market's a lot more volatile, then that's a lot more likely. But back in January, when the market was almost fearless, then you just get paid so much less for taking those risks of having to pay off on your short options. And so when you compare the two time periods, you can see that the April Condor simply offers a much better risk-reward trade-off than the January Condor, which is why some options traders love to trade in these volatile times.
I wanted to let you know that there really are sound, viable, long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective technique that some of the greatest investors in the world like Warren Buffett use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it.
So now let's move forward to expiration day, which is May 1st on our Iron Condor, the trade that we entered in the middle of all this market volatility. And as you can see, the NDX index closed at 87.18. So it had moved down 150 points from where it was trading when we first entered the Iron Condor. So now, on the day that the options expire, your brokers value each of the options that you are short or long, and then determines whether you owe anything on any of the options that you've sold or whether you're entitled to any payments for any options that you bought. So let's analyze each option in turn and see what those values were when the Iron Condor expired. Well, the 9130 call that we bought was 412 points above the closing price of 87.18. And remember, there's no payment to us as the owner of the call unless NDX is above the strike price of our call, which in this case is 9130. Well, NDX is 420 points below our strike price, so that option obviously expires with no value. Well, the same is true, though, for the call we sold at 9110. That's also way above the closing price, so that one expires worthless also. And remember, now puts only respond if the market gets past the strike of those puts. And as you can see, both the put we sold and the put we bought, both of those also have no value. They're way below the market. And so therefore, all four options expired worthless and no one owes anyone anything. There's no settlement value to any of the options. So the cash you received at the beginning, that initial cash flow you get to keep, in other words, that's your profit, and the options just die. But what's crucially important to understand is that for the same trade in volatile times, the potential of the two trades are not even close. The April trade had an actual return of 68% because we received so much cash and our risk was also much lower than normal by virtue of our having received that much cash. Whereas the same trade back in January, as long as the market stayed anywhere between 250 points above the index price and 300 points below the index price, the most we could make on that trade in 4 days is 11% of our risk. And that's actually a pretty great reward for a 4-day trade, 11%, but 68%, well, that's astounding. So the crucial takeaway from today's video is that when times are volatile, the options market will offer you incredible risk-reward opportunities for large potential gains in very short periods of time, such as this example of a trade that starts and finishes in 4 days for a 68% return. In less volatile times, wonderful trade opportunities also exist, but they become ridiculously attractive in volatile times like the ones that we're in right now. Professional traders have the knowledge to understand these relationships between market volatility and options pricing and know full well how to take advantage of them. As you move to trading professionalism yourself, you'll also begin to see these opportunities emerge all the time and have the know-how to take advantage of these situations and improve your returns significantly.
Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window so you won't lose this video. Don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.